Not sure if you've heard the news or not, but the IRS is switching things up in 2023 because of the insanely record high inflation that we've experienced in 2022. There are new tax brackets and a new standard deduction. So what does this mean for you? Well, welcome back to RoundUpSave, everyone. Our goal with this channel is to demystify money and financial independence, and today we're going to be talking about the IRS changes to the taxes. So 2023 tax brackets. Let's talk about it. This is the income that fits in each tax bracket for 2023, and this is really the only change. Put more simply, the federal marginal tax rates will remain the same in 2023. This is unless some new legislation goes into effect to change tax rates or brackets further. Each tax bracket has been adjusted for 2023 to account for inflation, as shown in these tables for single individuals and also married filing jointly. Now, for the 2023 standard deduction, there is some good news for taxpayers regarding inflation. In 2023, the standard deductions will increase. So for married couples filing jointly, the new standard deduction in 2023 will be $27,700. This is a jump of $1,800 from the 2022 standard deduction, which was $25,900. The 2023 standard deduction for single taxpayers and married filing separately is $13,850. This is a jump of $900 from the 2022 standard deduction, which was $12,950. So why is the standard deduction important and how does it work? The standard deduction is the number of tax deductions that you can subtract from your income before you owe taxes. So for example, if you were a single filer and made only $13,850 in 2023, you could take the standard deduction. This gets subtracted from your taxable income and technically not owe any federal income taxes at all, but you would probably still owe payroll taxes and state taxes. Obviously, this is not completely realistic to make only $13,850. But let's say you made $50,000 as a single individual. If you put in pre-tax dollars into your 401k account, HSA, or even commuter benefits, this lowers your taxable income. So let's say altogether for these, you put in $5,000, so now your new taxable income is $45,000. Before getting taxed, you would subtract the standard deduction from the $45,000 to get $31,150, and this is the amount that you are actually taxed on. So having a higher standard deduction is a really good thing. There's also a higher earned income tax credit, EITC, bumping the write-off to a maximum of $7,430 for low to moderate income taxpayers. And if your employer has an HSA plan, people can now put in up to $3,050 into their flexible health savings spending accounts. Overall, it's important to understand at a high level what these changes mean for you. Making money smart moves and minimizing your tax liability is something that should be considered throughout the year. Tax planning goes beyond just filing your tax forms in April once a year. If you like content like this, please make sure to hit that subscribe button and like the channel to follow along. We so appreciate your support. Thanks everyone, and see you next time on RoundUpSave.